Hi there. My name is Max Fawcett, and I'm the lead columnist with Canada's National Observer. On today's show, my guest is Rory Johnston. He's a former bank economist and the founder of Commodity Context, a subscription service that helps traders, investors, and other clients understand the oil market. He is, as you can probably imagine, in very high demand right now, and I'm kind of thrilled that we got him to spend some time with us and help us demystify a little bit of what's going on. So, Rory, welcome to the show.
Thanks for having me, Max.
So just before we get into the nuts of it here, you tend to talk to more financially minded audiences. You're doing interviews with Bloomberg, and they understand a lot of the jargon, a lot of the terminology. My audience, our audience, very smart, very savvy, brilliant people, love them all. But there are some bits of jargon that may fly past them. So I think just for both you and I, when we're talking about some of this stuff, we should be mindful that we're talking more to a general audience and we got to kind of dumb it down at some points where we can. But let's not dumb it down too much, okay?
Sounds good. And anytime I dip into necessary jargon, I'll heavily explain what I'm talking about.
Perfect. Okay. So on a scale of 1 to 10, with 10 being complete societal collapse and 1 being, the best day of your life, how bad are things right now in the oil market?
So interestingly, I would put that, objectively looking at the oil market right now, prices, inventories, time spreads are essentially a measure of how scarce barrels are. We'll get back to that in a second. Yeah. The objectively right now, looking at those indicators, we're at kind of like a 6 or 7. I think that's surprising because I would say that I would have expected us to be at an 8 at least right now. If not a 9. And I think, 10 is going to be reserved for the worst case scenario where if we were back in March and we didn't get the ceasefire and Iran started bombing regional oil production infrastructure, that's the 10. That's the kind of societal collapse, $250 plus oil, kind of global, advanced world recession, emerging market depression likely. That's the kind of situation we would have been looking at. We have thankfully, I think, avoided that scenario, at least for now. There's always a chance that we get back towards that being a risk. But I think we have, with the announcement of the ceasefire and the clear signs from the Trump administration that they do not want to re-engage in the war fighting and the actual kinetic action, that this is now a long slog negotiation, which brings us to other issues in terms of prolonging the closure of the Strait of Hormuz. But, even if it takes an extra 2 months, that is really, really bad. And we'll talk about why that's bad. But it's better. Even that is better than, say, a different scenario where a bunch of stuff got bombed and then it's going to be offline for years. So we have avoided that worst case scenario. So let's talk about the scenario we're in, which is that, the main kind of biggest tail risk we seem to have moved past. But now we're in this kind of stalemate where the Strait of Hormuz, the most important oil artery on the planet, as well as an artery for many, many other kind of critical feedstocks, mostly still related to the oil and gas industry, has been closed now for going on. I've lost track of how many days. I used to keep track of how many days it was closed, and now we're 2+ months here into the closure. What are we looking at? Yeah, 2.5 months. That's a lot. At this stage, you've seen... maybe let's just bear down on the barrel counting for a second, just to kind of parameterize kind of the audience's understanding of the numbers we're talking about.
Totally.
Prior to the war, the Strait of Hormuz, shipped roughly 20 million barrels a day of oil, which is, just for perspective, roughly 4 times as much as Canada produces in total, and the entire, basically 20-ish% of global oil production and demand. For nice round numbers, let's assume it's 100 million barrels a day. It's slightly higher than that now, but let's keep the math really easy. So 20%, big hit. Thankfully, we had some offsets, most notably the Saudi East-West pipeline, which transferred a good chunk, between 4 and 5 million barrels a day, depending on the source you're looking at, from the Gulf to the Red Sea, as well as a couple other pipelines. There's one that the Emiratis have at the port of Fujairah on the Gulf of Oman side. And up until recently, over the last month, Iran was still exporting a lot of its oil, most of its oil. So all of this helped reduce that 20 million barrels a day to more like, let's say, 13 million barrels a day. And that's the volume of oil that for the past 2+ months has been forcibly shut in across the Gulf. And the reason it's shut in is that they don't have anywhere else to put it. They've overfilled domestic storage tanks, you've run out of tankers. And for anyone in Western Canada, going back to 2018, the idea of a lack of egress forcing curtailments or production shut-ins should be very familiar. It's the same functional problem. Now the world is digesting this loss of the largest supply loss in the market's history, and the cumulative effect of those 13 million barrels a day that have been shut in now for 2+ months we're looking at roughly 700 million barrels of oil that we had expected to be produced this year that now isn't being produced this year. And banking and factoring for restart times and everything else, we're talking about at least a billion barrels, probably more like 1.5 billion barrels, which is a lot of oil. So the question is, why aren't prices higher right now? Because I think that's the question that's been dominating the past month of my life.
Totally. Like, when you read the financial news, certainly my sense is everyone is kind of wondering when the shoe is going to drop. It feels like we're sort of Wile E. Coyote run off over the cliff, but we haven't fallen down yet. And the question on a lot of people's minds is, when is the market going to take this as seriously as it feels like it should? So what's your sense of that? I mean, is the market seeing something here that the rest of us aren't? Is it looking around the corner as sometimes is said, or is it just completely blind to what is happening out there?
Yeah, so I think let's break it into kind of what's knowable and what's not knowable. So the knowable aspect, there are reasons that we can justify that prices pulled back from their recent highs in late March, early April. Most notably, I think the announcement of the ceasefire and the avoidance of kind of a slip into an even steeper and kind of more worrisome war in the Middle East. That, I think, given how apocalyptic that would have been, even a kind of a small probability of that was worth a lot on prices. So removing that or reducing that probability has kind of a leveraged effect, or kind of a bigger than just a linear effect on the price. So I think that is a justifiable reduction in prices and one reason we've stepped back a little bit. The other issue and the other factor here is that we've been processing this war, as I'm sure you have daily, like the rest of us, kind of on a tweet by tweet, kind of minute by minute, things are changing. That makes us feel like a lot is happening all the time. But in the oil market, things move so much slower. Ships coming out of, like, for instance, someone had asked me why there was a jump in U.S. imports of Iraqi data in the latest weekly data published by the U.S. Department of Energy. And I was like, oh, that's interesting. Yeah, because you would have expected that Iraq's not exporting much oil right now. And there was a tanker that landed in Los Angeles this past week that left the Strait of Hormuz on February 22nd. So there are still barrels that were shipped out of Hormuz that are still kind of finding their way to their final destinations and are taking even longer than we would have expected. So I think all of this stuff is lagged in how it's finally hitting the market. And I think that, to a degree, while I would have expected more panic and a kind of a faster and more durable run-up in prices, given the fact that we started the year in an oversupplied situation, a weak market outlook, high stocks, you can make the case that the prices we have right now are reasonably justified based off of the fundamental inventory data we have access to right now. But if that continues and Hormuz remains closed, it still points us to the same direction, which is that prices need to continue to grind higher to eventually destroy demand. Now, the final piece of the kind of known stuff is the jawboning. And this is, I think, another unique aspect of this crisis that makes it difficult to compare to past ones, is that the Trump administration has kind of unprecedentedly intervened in the market repeatedly. Now, there's a lot of debate about if there's actual, like, outright direct, treasury shorting futures, et cetera, et cetera. I think that's mostly overblown at this stage. I too was curious at one point, but I think that at this stage, yes?
Yeah, just to clarify. So the theory there is that the US government is actually shorting the oil market to keep prices down uh, as a sort of deliberate effort to contain the fallout.
That's exactly right. And and there's also been discussion that the Bank of Japan was at one point discussing intervening because of, Japan is very vulnerable. The yen was under fire, so they were trying to support the yen. Anyways, long story short, this is a rumor and a kind of a concern in the market to the point that some of like the leaders of the exchanges actually like release statement like this would be a very, very bad thing for the kind of integrity of these markets and the usefulness of them to market participants going forward. So I think that's likely not happening. But what we definitely have seen verified is that, about 10 times or so over the past 2.5 months, we've had a tweet or a True Social post by the president, let's say 8 or 9 a.m. I'm usually like getting kids to school at the point at the moment that these tweets drop, that, we're wrapping up, war's done, everyone go home, no worries, and the price will plummet by $15 in 15 minutes. So if you are, because at the end of the day, these are behavioral, like these are humans trading this stuff at the end of the day that have risk tolerances. So if you're at $110 for Brent crude and all the fundamentals, the supply deficit that we're talking about, points higher, but you would look back at the past couple of months, you're like, every time we get up around here, Trump says something and the market pukes to the downside. Well, maybe I'm just going to cover my risk now, and maybe I'm going to let someone else take that upside. I'll ride it from like 90 back to 110, but like I don't know if I want to be here at 110. And as soon as the selling starts, I'm getting out. So I think that has also made it difficult to price that upside risk in a more meaningful way. So those are the things we know about.
Eventually, though, that upside risk, if the barrels don't start to move the way they did before, there's only so much jawboning and possible intervention that can happen before the reality of there being no barrels available reaches our sort of local refineries and local gas station, correct?
That's exactly right. At the end of the day, it's a physics problem. Like it's stock flow model, and if the flow stops and you draw down all your stocks, you don't have anything left. So this has to eventually, Hormuz either has to reopen, or we need prices to rise to destroy something like 10 million barrels a day of demand, which we've never done before. That was like that was around the volume of demand that we destroyed during COVID. And that was with forced mandates and lockdowns and travel bans and, a global pandemic. So unless, hantavirus decides to become a major thing, which God hope no, that I think that all of this, you would need to have prices. And like I asked the question, at what price would you re-engage in the behavior of COVID? And the answer is extraordinarily high. For most of us in the advanced world, in the kind of, wealthy markets, we likely will just pay whatever price is required of us. But that does push that demand destruction down to poorer people in kind of less prosperous countries in the global south. And I think that is where you would see this not as just a pain at the pump, but like literally a lack of supply, physical shortages. The other piece here that I think is I mentioned that there's stuff we don't really know. And there's active research that I'm still trying to do to understand this very, very confusing market. And one of the things that is kind of, among market people trying to follow this, there's a lot of mixed signals coming out of China as well. That China, obviously the world's largest oil importer, vast majority of that came from the Persian Gulf. So it's seen a large reduction in imports, and we've seen indications that its refinery activity has turned down. Normally that means that we would expect that means a big collapse in demand in China, which is odd given that prices are still only high-ish, not at those crisis levels. And you look at other indicators like flights in China, and they're still flying just as much as they were last year. So the question is, where's the oil coming from? So right now, on top of everything else that we do know that is confusing enough, the stuff that we don't know is, is China pushing a bunch of invisible or statistically non-visible barrels into the market from its strategic petroleum reserve and just not telling anyone. So that is also kind of adding to this. And I think in the market, there's such a tendency for, prices to drive narrative. So right now, prices are much lower than we would have expected them to be. Everyone's trying to say like, okay, this is why, and it must be that China's destroying demand at only $100 a barrel, which has a lot of very, very bearish or kind of price negative consequences in the long term. But I would say that like the jury's still like roundly out on this being kind of a firmly established fact yet.
I want to focus on that long term because we bring it down to the level here in Canada. I think there are sort of two parallel conversations. One of them is the consumer level, what this means when you have to go fill up your car at $2 a liter, 210, 220, and what that does to people's behavior. The other one is what does it mean for the oil and gas sector and sort of the long-term trajectory of this major part of our economy. So I have a theory. It probably won't surprise you. I have a worldview on this, and I want you to hear me and then either tell me if I'm right or if I'm wrong based
Okay.
on your perspective. So, my view is that this is obviously, good news for the oil and gas industry in the near term. They'll get more money for their barrels. They will find ways incrementally to increase exports, although we're sort of getting to the limits of that right now. I think we'll see, TMX expanded as much as it can be pretty quickly, and that will help the industry as well. I think this is net negative in the long term for the oil and gas industry because I think the lesson that a lot of their customers are going to be learning from this, customers in China, in India, in Southeast Asia, in all the parts of the world where all of the demand growth was supposed to come from, the lesson they're going to learn is we can't rely on this system. This system is beyond our control, and it imposes costs on us that create recessions, damage the currency, and in some countries, like possibly will lead to starvation, will lead to like real material negative consequences for the public. And so we have to replace this system as quickly as we can. Good news, we have a lot of sun in the developing part of the world, the southern part of the world, and batteries get cheaper every year, and so we're going to go down that road as much as we can. And so, yeah, in the near term, these companies are going to post really, really big profits. But in the long term, it's very bad for their business and it's very bad for the viability of another pipeline to the West Coast. It depends on there being robust demand for an additional million barrels per day of production coming out of Canada. And it needs that demand and those prices to be strong out to 2050, 2055. I don't see how that can be squared with what's happening right now to the customers of that future demand. So good in the short term, bad in the long term, and probably a negative for any potential pipeline. What do you think?
I would agree, disagree, and I'll go through why. I think it doesn't need to be, explained why this is good for the oil sector in the short term. Higher prices, more money, thumbs up. Yeah. In the long term, I agree. I think that there's no way that I do not see this reducing the trend pace of global demand growth. And in any world, if right now in 10 years versus February in 10 years, I expect Asia will be consuming less oil relative to that kind of no war scenario. I think where I would quibble is on the value of the West Coast pipeline in this. And just for the perspective, this is this is not Trans Mountain. This is the West Coast oil pipeline, the million barrel a day, what I was calling the MOU pipeline. So what is this thing, right? And I think that in some ways, this crisis accentuates the same growing argument for that pipeline in a way. So I don't disagree that a decade from now, the market competition could be less favorable for all oil producers. I concede that point. But I think that when it comes to the fact of how does Canada go forward here, let's look over the last 2 years already. Even before that, there was already this mounting narrative that we need to get around the United States. Back even before Trump too. This was, when Biden re-canceled Keystone XL, U.S. is an unreliable kind of market, da-da-da-da. Now, with, this time last year, we were in the middle of a trade war with the United States. There was a brief period where the United States was actually going to put tariffs on Canadian oil. About 2 or 3 days, we actually saw that actually expressed in market pricing, which was very concerning and very weird to see. It for those that, it basically blew out the price difference between Alberta prices and Houston prices for the exact same barrel of oil. It looked like we were having another pipeline crisis in the data, but obviously the pipelines were not full. So I think that I think was a particularly existential reminder of the risks of this kind of monopsony relationship with the U.S. refining sector. And for those that aren't aware, monopsony is the opposite of monopoly. So basically, they have a dominant buying position that we do not, as exporters, have any ability to sell to anyone else. And I think this is really punctuated by this idea that when you look at the research of how tariff burden over the past year fell on U.S. fell across the economy, 90-ish% of it for most exports in the United States, 90% of those tariffs were paid by Americans, either through higher prices for consumers or through margin compression, i.e. lower profitability for U.S. companies. In the case of Canadian oil exports to the United States, it was likely going to be at least a 50-50 split because we didn't have the option of sending it anywhere else. So I think that was like point number one. There was always this argument to get to the West Coast because of Asian market growth, et cetera, et cetera. And now I think you have this additional element that, not only is this an unreliable market, it could potentially be a hostile market. And then in January, we had Venezuela and the kind of overthrow of Maduro, the kidnapping of Maduro. And what you saw at the time was that a lot of the kind of more MAGA adjacent or associated accounts talking explicitly about this as through the frame of this is how we kind of put Canada over the barrel, right? This is, we get, and now even, what was it, yesterday, Trump posted the 51st state over Venezuela, right? And I think all of this was, if they have Venezuelan heavy oil, they don't need Canada, and they can drive a harder renegotiation of USMCA or whatever. Mm-hmm. All of that, I think, kept pointing that direction of we need other options. We need strategic optionality here. And now finally we're having a crisis where, it would be great to have more access to that market and not have to fight our way through the U.S. continental United States to get to Houston to re-export barrels. Because right now, for those that aren't aware, the primary area that our barrels exported to the world will grow without a West Coast pipeline is through Houston and basically through the U.S. Gulf Coast. So as this market continues to evolve on its own, we will, the largest portion of our oil will enter world markets through U.S. ports, which is economical, sure, but I don't see it as strategic from a sovereign perspective. So I think that this is one of those things. Do I think the pure commercial economics of it work? Not really. But I think that this is one of these things where it has value that I do not think can be recognized by the private sector. I don't think you can have, your Suncors and your Canadian Naturals and your Cenovus's, et cetera, Imperial, they can't factor in strategic optionality. Theoretically, if they could all band together as one conglomerate, they could, but we have antitrust laws to prevent them from acting as an industry in that kind of cohesive manner. So again, that falls to either, I think probably both, the federal government and the Alberta government to provide some kind of concessional capital to get this thing across the finish line, because it becomes more of a strategic and sovereign risk rather than a commercial economic one. So that's my pitch for why I think that this scenario keeps the West Coast pipeline in the running.
So you could get me there on a sovereign pipeline, right? Pitching me on, and I still don't think it'll go through the North Coast, but that's another issue for another day. A pipeline to the West Coast for national sovereignty related reasons. But the table stakes there, to me, and I think to a lot of Canadians, are number one, Alberta has to acknowledge that climate change is a thing. It has to acknowledge that it can't double its production because that's not a realistic thing. And it has to acknowledge that it is not being asked to carry some special burden when the federal government has an industrial carbon tax that amounts to 50 cents a barrel, right? The sort of special pleading that has come out from the oil and gas industry over the last few weeks about the industrial carbon tax, I think rubs a lot of Canadians the wrong way. And it makes it harder to sell the idea of a sovereign pipeline when it's almost being presented as a demand, right? Give us this or we're going to break the country, as opposed to give us this so we can secure the country. I think that would be a far better sales pitch, and it's not the one that we're getting right now.
Well, I agree with you that securing the country and having a positive sales pitch is definitely the way to go. And I had the opportunity to present to the House of Commons Standing Committee on Natural Resource Exports and did exactly that. Because I do think that this is, I think we've known each other long enough. It's not going to shock you to hear that that's not my type of politics. I view this through something as the oil and gas industry is a massive strategic resource for Canada, for Alberta, but I think for Canada writ large. And I see that we just need to think about it like that. And I think that, I do not like to bemoan the Trudeau years. Things you liked, things you didn't like, whatever. But I think it's not wrong to say that during that period, Ottawa had an embarrassed relationship with that strategic resource. And I think the thing that we now see in the Carney government is, at the very least, we can quibble about the exact details of how we're getting it done and how they're getting it done. But I think it's undisputable that there has been a massive change in tone from the top. And I think when so much of the prior criticisms of Ottawa were effectively tonal, I think that is a huge thing. So I still want us to get to a better place. And I want, again, even when Carney initially announced the MOU, there was a big push on it being a private sector constructed, private sector financed pipeline. Didn't say private sector owned, I'll note, but there's lots of wiggle room here. But I think in general, one of my concerns is that Carney may believe that under the right conditions, there would be a private sector proponent for this pipeline. And I worry about that because I do not see it the same way. I think that you mentioned the Trans Mountain second expansion, another 360,000 barrels a day there. We have 400,000 barrels a day of expansion capacity on Mainline, the main Enbridge system that transports the vast majority of Canadian oil. And now you have this Bridger expansion pipeline, or I think they've renamed it now the Prairie Connect pipeline, that connects into the old Keystone XL assets through the bottom of Saskatchewan. And so I think all of this is, if we do not take a positive step in terms of making this a sovereign pipe, then I think the private sector will do its own thing. These barrels will find a way to market eventually. I'm not as concerned as, say, I would have been, 5-6 years ago, where it's like we just have nothing on the horizon for egress. Thankfully, we're in a better situation now, but most of those expansion opportunities lead south. And I just don't, if we have a chance to take an active step in shaping our future, I just think we should do that, and we should do it through Canadian ports.
What about the risk of, let's say the federal government or the, government of Alberta, government of Canada, maybe the government of BC, who knows, underwrite sort of a joint project, and they, they control all the revenues, they get the benefits from it, of a new West Coast pipeline. Would the oil sands companies want to invest in an additional 1 million barrels per day of production coming from higher cost projects? They would have to start doing greenfield oil sands projects again. Those tend to come in pretty expensive. Do they have the risk for that anymore, when their investor base has, over the last decade, really kind of wanted all of their cash flow to go to dividends, to go to buybacks, basically to go back to shareholders rather than going into growth? Are the companies, I guess it's just sort of to be more explicit, are the companies the real sort of roadblock here in terms of filling another pipeline?
I think that, while I agree that I think like the heyday of kind of greenfield, mega mines and stuff are likely behind us, I would like to see Suncor's base plant renewed. But I think in general, I think the rest of it is, I think we're not going to see another kind of massive new mine built likely. But I do think that just through brownfield expansions of existing SAGD or thermal assets and projects, you can probably add kind of 75 to 100,000 barrels a day each and every year out the next decade. And I think that is kind of the scenario here. And that's why, and if you actually look over the past couple of years, Canadian production has continued to chug along. Continually, one of the largest sources of non-OPEC supply growth in the world, typically just behind the United States. That I think is, that's something that will continue as long as there is egress. You hear lots of complaints from the sector about not growing. And you hear the same thing from the shale patch in the United States. And inevitably, they're going to grow. I think at the end of the day, engineers love number go up. And volume is the way that happens. They want to exploit this resource. They want to get more, fluid through their system. And as you grow production, particularly out of these, in brownfield, well, I mean brownfield expansions rather than greenfield new builds, your unit economics also get cheaper, right? Because you're spreading more and more volume over less and less overall initial infrastructure. So that also helps and reduces the overall production cost of all those barrels as well. So I do think that they will do. I think there's other things that we can do on the kind of regulatory and permitting space, and I think there is progress in some of these things that will help facilitate and kind of grease the wheels on that. But my main focus here is on the egress itself, is giving an equal opportunity for those barrels to compete in a global market and not just kind of be shuttled back into the U.S. Midwest, where they always have to go and then make their journey all the way down to Houston to finally get, like, for instance, let's make this concrete. So last year, you had Energy Minister Hodgson at India Energy Week talking about growing Canada's ties with India, and I've been at events with with Indian diplomats, and they've all talked about how they want more Canadian resources, they want more Canadian oil. Right now, India was one of the first buyers of one of the first cargoes that came out of the Trans Mountain expansion. But because we cannot fit the biggest tankers, we cannot load the biggest tankers at Westridge, and we could not get the biggest tankers out the port of Vancouver, you basically had 3 smaller tankers that ship-to-ship transferred to a big tanker, and then that tanker went to India, and that was the only one they ever bought because the logistics were very onerous and confusing and complicated. But there's a lot of people, and during this period, I had journalists call me and like, why don't we send more oil to India? Or why don't we send any oil to India? And actually, we do. We're just sending it out of Houston. We ship 1 to 2 of these big tankers every month of Canadian heavy crude to India, but it has to go through Houston and Louisiana area because of the infrastructure. They can load these bigger tankers. So again, if we want to diversify our trading kind of relationships across larger numbers of these partners, we're going to need the infrastructure to facilitate that trade. And right now, the Americans just have more of it.
Couple more questions here just to wrap up. How do you think about what's happening with OPEC right now? We've seen the UAE, United Arab Emirates, basically leave the cartel. It's a pretty large producer. They want to produce more. Isn't Canada exposed to the risk of another sort of breakdown in OPEC or OPEC's decision to pursue market share over price? And doesn't that diminish or curtail the appetite of industry to invest in new projects, new production, when OPEC is looking a lot less reliable and looking a lot more like we could just get an all-out price war in not in the near future, because of course I think even once the Strait of Hormuz opens up, we're going to probably have a year or two of just rebuilding stocks in countries around the world. They're going to have to replace the barrels that they've taken out of storage. But at some point, the glut that was there will probably reemerge, and it may be even bigger if there's a fight for market share and a breakdown in OPEC. So how do you think about how that impacts Canada?
Yeah, I think undoubtedly, the UAE's departure from OPEC means that the UAE is going to produce more oil at the other side of this. I think there's been a lot of talk about the various reasons they've left, and I think they are many. But the most important one is that unlike the rest of OPEC, which is actually on an average member basis, actually seen production capacity fall over the past decade. Since 2019, the UAE has increased production capacity by over 1 million barrels a day, and it has not been able to monetize that or utilize that production capacity because of OPEC's kind of unending series of production cuts and market management efforts. I am talking about this from the perspective that, like, the UAE's, there have been many premature obituaries written of OPEC, like many. It's like the death of NATO. It's happened 1,000 times. And my base case here is that they muddle through. But this is not, Angola leaving OPEC. This is arguably the second most important member of OPEC, behind only Saudi Arabia. The UAE produced slightly less than Iraq, but actually held, importantly, more spare capacity because of that investment push. And spare capacity is the real currency in OPEC. On top of that, the UAE has been the target of more attacks on the UAE than the rest of the Gulf combined, which the UAE is not especially pleased about. And I think for them, it's like not only were they withholding their production for like the better good of its brother members in OPEC, is a member of the GCC, all of this under the idea that like the U.S. Carter Doctrine was going to protect them if like stuff hit the fan, and then it hit the fan and there was like nothing to protect them, right? So they're kind of like, what are we getting out of this? So I think it's reasonable. And I think the other thing here as well is that OPEC had, the UAE had like 1 foot half out OPEC for years now. The UAE, like the worst kept secret in the oil market was that the UAE was roundly cheating its quotas, and the data that was being reported by OPEC was not right. They were probably overproducing by 400,000 or 500,000 barrels a day. So again, I think that also points to the fact that like the supply shock on the other side is not going to be quite as large as implied by OPEC's official data, because UAE was already really overproducing those numbers. But I think all in all, there's no doubt that it means more oil post-war. I think this could mean a more cohesive OPEC going forward, the optimistic case, because the UAE had basically emerged as the main spoiler of Saudi policy direction. So it could be a more Saudi-dominated, unitary OPEC going forward. But I do think that undoubtedly this is a very delicate moment for the organization. And if they do not stick handle it right, I think this could, as Hormuz reopens, everyone basically bolts for the door to try and produce as many barrels as they can. How does OPEC reestablish control there? It's still an open question.
Yeah, I mean, what happens? And I'm asking you to do a lot of forecasting here, but I feel like that's part of your job, part of why you love this. But what happens when these countries that have spare capacity realize that demand is rolling over, that demand is in decline and maybe accelerating because of what's happening right now with Iran and the electrification of economies in the East and the South? Is there a free for all? Do they try to get their barrels out as quickly as they can before demand declines even more? Do they try to drive prices down to prop demand up? Like, what does that chaos situation look like, and how quickly do you think it could come?
If you believe the UAE, this is actually one of the things they've cited as kind of one of the rationales. I am mixed on this. I think this was a major talking point almost a decade ago, when Mohammed bin Salman, MBS, kind of rose to be the top spot, the crown prince and the functional ruler of Saudi Arabia. He was like, when he was introduced to the public, he was the kind of tech adjacent millennial prince that wanted to transform the kingdom and everything else. And there was at one point, there was this discussion that he was going to basically push OPEC to produce full out, to monetize reserves, to pump that money into luxury vacation destinations and, cities in the desert and Neom and all this kind of crazy infrastructure. But push comes to shove, COVID hits, and then all of a sudden they're back to production management. And then not only were they back to production management, but they got it in their heads that they could keep production, or they could keep prices high, like $90, $100 high. And this glut that we were experiencing immediately before, Hormuz was closed, was entirely a direct result of OPEC's actions to begin cutting production again, and kept way too much off the market from 2022 through the beginning of 2024. So it really was like, I think personally OPEC was doing a bad job at its primary job during those recent years. And that's where most of my criticism of the organization has come from, because I actually think they serve an important role in managing the market. I just think when you get a little greedy on the upside on price, you inevitably kind of create these moments where you have to pay it back. And that's what we're in the process of doing prior to the war.
Mm-hmm. Well, we could probably do this for another hour, another 2 hours, but I'd be respectful of your time and respectful of the listeners' time. But never a dull moment on the oil market, and even if you're not trading or investing, I would encourage everyone to follow Rory on social media on Blue Sky. Yes, I guess on Twitter if you're still there, but he's also on Blue Sky. Let's follow him there, build up his following there, and convince him to stay there. Yeah, it's important to understand how these things are working and what the dynamics are, even if you are steadfastly opposed to oil growth and worried as I am about climate change. I think it helps to know these things, and Rory always gives it to you without any of the bullshit. So thank you for that, sir.
Thanks for having me, Max. Always a pleasure.